Hi friends, welcome back to the channel. This morning, the Fed Chair, Jerome Powell, spoke alongside with the heads of ECB and the Central Bank of Brazil in a panel discussion. So it was a really interesting opportunity to see his latest thoughts and comments on the labor market, the state of inflation, as well as the future path of rate cuts. The key problem right now is how well is the Fed going to strike a balance between cooling down inflation and not harming economic growth. The market currently projects 2 cuts between now and the end of the year, one in September, one in December. We'll see if Powell pushes back on this expectation and if his thoughts have deviated from what he said in June FOMC, especially after the latest PCE data. So let's get into it. So the first thing that Powell has noted is that the labor market is cooling off appropriately. What this means is that yes, the labor market is cooling down and the supply-demand gap is closing in, but it's not actually cooling down too fast that would worry the Fed. So importantly, right now, the unemployment rate is 4%, and it has moved up from 3.4%, but 4% is still historically low. Powell even mentioned that, to go back to the 3.4% unemployment rate that we saw earlier last year, you'd have to go back to his teenage years. So the Fed is really not that worried about the state of the labor market. If anything, a cooling labor market with a slower wage increases would actually help reduce inflation in the services sector, which we'll talk about in a second. So the labor market has been strong, and we've analyzed why this has been the case. First is because there's a structural issue. There's not enough supply of labor to meet the demand. And so far, the non-farm payrolls have been supported by immigrant workers as well as high participation rate from women workers. So these two important factors are still at play to hold up the labor market. And it hasn't really been damaged by a cool down in inflation as well. So the Fed has a lot of confidence in the labor market strength as well as the overall economic growth. And Powell has mentioned that the labor market is actually moving along the famous Beverage Curve. So the Beverage Curve is a famous economic concept that the job opening rates and unemployment rates have historically held an inverse correlation. As you can see, that the fewer there are job openings, the higher the unemployment rate, and so the curve is a bit higher since COVID, but it's still moving in with this sort of right relationship. We haven't seen an update of this curve since 2021, but the Fed believes that the labor market is moving to better balance and is not out of the historic norm or the theoretical norm that you would expect. So now moving on to inflation. So yes, inflation was a little bit sticky in Q1, and that did get the Fed very worried. But moving from the peak of 7.1% or 5.4% in the headline core PCE inflation data to the latest reading of 2.6%, which was released last Friday, is still a very strong progress, and that's what the Fed wants to see. Powell does not really expect the economy to get back to the 2% target this year. It might take another year or even 18 months or so. But it's the progress that he feels encouraged by. But within that progress, he's still worried about the persistence of services inflation, which includes what you would normally expect when interest rates go up is that the housing sector, including house prices and rents, should go down because mortgage rates go up. So the cost of servicing the house is higher, and there should be lower demand for housing and rent. But it's actually taken a much longer time frame than the Fed expected for that dynamic to work through. So the Fed, I think, expected 1 year. It's been more than a year, and the housing sector is still very hot. And then secondly, on the service sector without the housing components, it's still the Fed still wants to see more progress in that area, and they know there is a direct relationship between the wage increases and core inflation, and so when the labor market comes into better balance and cools down a bit further, we should expect to see wages to decelerate. It doesn't mean it will go down, but it should mean deceleration of the increases. So when the wages decelerate, the employers don't have to pass on as much cost onto the price of their services and products, which means lower inflation. And actually, even more recently, we have seen that consumers have traded down. The businesses have less room to increase the pricing. So overall, that should mean inflation should still make the progress towards the 2% goal. The Fed is very confident about it. They're just not really sure about the pace and timing. They just need more data to observe this before deciding on the first cut. So this is the quote from Powell today. The risk on the inflation side is that you move too quickly, inflation comes back. And what that means is that when you have to come back and raise interest rate again, it could disrupt overall economy and hurt the economy. You don't really want that. You want to put inflation back down towards 2% and keep it there. But the other risk is that we wait too long and we understand that the labor market softens too much. Perhaps we lose the expansion of economic growth. So what Powell is saying here is that if we cut rates too late, there's a chance we hurt the economy too much, and then the pendulum swings all the other way and we have a recession. Again, that is not something Powell wants to see. The Fed wants a no landing to a soft landing scenario where the economic growth doesn't get hurt too much by the rising interest rates. And finally, after today's speech, the Fed on futures moved very little. It's slightly bull flattened. All that means is that the yields went down slightly, and the 2025 yields went down by 3 to 5 basis points, and the 2024 yields went down by 1 to 2 basis points. So we are still expecting, or rather the market is still expecting, that the Fed will cut in September as well as in December this year. So 2 cuts still. I think to change this pricing, we really need to see, like very ugly inflation data, CPI and PCE spiking up again over the summer, or if Powell comes out and just says we are not expecting to cut rates. So barring those situations, the Fed doesn't really like surprises either. We might actually really see the first cut in September. Historically, the Fed has not kept interest rate at a high level, at the terminal level, for that much longer than 12 to 18 months. So now we're getting towards the longer end of that waiting period. So that's why the market expects the first rate cut to be in September, even if Powell doesn't say that. So that was quite a quick summary of what Powell said and the Fed's latest stance on inflation, labor market, and the rate cuts. If you like our discussion, please, and if you have any questions, please leave them in the comments. But otherwise, please like and share the channel. I really appreciate your support. Thank you.